Good afternoon. This is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. And welcome to Market Minutes with a kind of a special edition here on April 2nd of 2021. And I am joined here by my colleague and longtime friend, Tom Kemler.
Hey, Eric.
We first worked together, I think 17, 18 years ago. Tom is now serves as our chief appraiser for our business valuation and appraisal practice. And so, given the fact that over these many years we've gotten together and loved to talk about the markets and whatnot, I thought we might try to have a little dialogue and a little chat today. And Tom brings a certain perspective to things, and sometimes it's a different perspective or a different feeling that I've got, and I think that's entirely healthy to have as a firm. And so, today we're going to take our maiden voyage into this adventure and see where it takes us. So I'll, as I usually do in the, with the program, I'll kind of go over some basic statistics, which were actually from the close of last week. But just to kind of get us started, that'll set the stage for some conversation. And kind of go over a little bit of stock information here that kind of, as I've kind of looked at it and kind of brought it to you all in the past, kind of treat it as news you can use. And then Tom will go over some of the recent economic data that we got actually in this week, and then we'll kind of drift off into a myriad set of topics, which I hope and I think you'll find interesting. So shall we go ahead and dive into it, Tom?
Let's do that.
All right, excellent. Well, again, this is for the data that I'm about to talk about is for really the end of last week. And we're compiling data. Obviously, today was not a trading day here on Good Friday, so markets are closed. But we'll have some more data next week that we can talk about. But as we kind of look at the equity markets, we know on a year-to-date basis, with a little bit of noise and a little bit of volatility, the markets have witnessed a fairly strong updraft year to date. Now, given that we're roughly 3 months into the year, so the S&P 500 as of last week was up about 5.6% year to date. The Dow Jones up about 8.1%. Russell 2000, a strong year, which follows on a fairly strong year last year, is up about 12.5%. And the NASDAQ, we've seen a little bit of a change in some leadership with regard to equities, after having been up 44% last year, is only up about 2% as of the end of last week. If we look abroad, we've got the MSCI EFA index, which is up about 3.3% for the year, which kind of dovetails with the MSCI Europe. Obviously, they've been dealing with some coronavirus case loads that we're not seeing here in the States, and their ability to distribute vaccines has not nearly been as efficient as we've seen here in the States. So if you look at Asia, the MSCI Asia was up about 2.5%. And emerging markets, which we continue to watch, given the status of the dollar, is up about 1.3%. If we look at bonds, I think the story remains the same as we've been bringing it to you over the last several weeks. Higher interest rates have weighed a bit, even though we've seen a bit of a pause in some of the gyrations in our 10-year Treasury. But the Barclays aggregate index is down about 3.3%. High yield is positive, as are leveraged loans. As we look at the commodity basket, crude prices remain fairly strong, even though we did have some news here recently out of OPEC Plus. And some indications of maybe some increasing production, but so far that's really been kind of a non-event with regard to crude prices, which WTI ended last week about $61 a barrel, which is up a fairly strong 26% year to date, when we were following on essentially a 21% loss a year ago. And then gold, as we've been talking about, impacted by negative real interest rates and this inflation perception move that we've seen. Gold is down about 9% after a 24% move a year ago. And notwithstanding what's happened to the dollar here over the last several days, at least as of last week, the dollar index, or the DXY, was up about 3.2% year to date, after falling about 7% a year ago. And with that, I typically would kind of go into some, economic data, but I think, Tom, you've got a pretty good read on some of the things that went on this week, and some surprise, well, very little surprise for the most part, but perhaps perhaps some good perspective that you could share with our listeners.
Sure, I'd be happy to. I'm going to share the screen here. And hopefully you can see the Chicago PMI number.
Got it.
Okay, great. One of the things we've been doing with covering the economic indicators, and we started this at the beginning of the year, was just looking at the indicators that were outside of consensus, or that came in pretty far away, because that's really what's newsworthy. And first, there's two things about that. First of all, I thought that by only going to the stuff that was outside of the consensus range, I mean, after all, there's about 24 high dollar economists at 24 firms that get paid to create the consensus range, and yet they're not hitting it. The numbers are coming in outside of their collective wisdom more than half the time. That's kind of amazing. And the second part of that observation is that, to kind of dovetail with what Eric was saying, with pressure coming up on rates and equities doing fairly well, is that these numbers have generally been much more positive than expected. So we'll dive in for an example here. The Chicago PMI, which is one of the purchasing managers index, it's one of the oldest and best surveys there is for purchasing out of the middle of the country. You can see this consensus outlook. They've had 6 straight months here of near 60 readings. This is a number that 50 is level, anything below 50 is negative, anything above 50 is positive. And in a mature economy like the United States has, numbers in the low 50s are probably what you would typically see. Getting up towards 60 is a very strong market anyway. And so the PMI number that came out on Wednesday blew away the consensus. The actual number came in at 66.3, which is up about 10% over the prior number, and completely blowing out the consensus and the consensus range. Very strong number. Dallas Fed, similar deal. The Dallas Fed is a number. A lot of the Fed numbers, they, instead of having a baseline at 50 like the Chicago does, the Dallas Fed baseline is 0. So anything negative is retracting, anything positive. So these prior numbers of 17 were very strong anyway. The consensus was that things would sag back a little bit, especially because February had been, you can see this, sampled before the Great Storm. So they thought that there would be some sort of retraction, but yet the actual numbers that came in, the general index came in that just completely obliterated the consensus range. These are numbers that I've rarely ever seen. I mean, they're so high. And this is the March number. And if you look at, this is the February number. If you parachuted in, you would not be able to know that we had a deep freeze that really just eliminated most economic activity for 10 days in February. 2 strong numbers back to back. Redbook, this is a measure of chain store sales, ex auto and ex gasoline. These numbers are running close to 10%. Again, very strong, and the strongest that I've seen in years. The Case-Shiller Home Price Index, home prices, part of my thesis this year has been a lot of the economic strength, and the reason why we're seeing so much strength in some of the more value parts of the indexes and away from, say, the tech heavy indexes like NASDAQ from last year, is that the home and real estate construction, and everything that goes into that, the appliances and what have you, that's all been very strong. And here again, they keep predicting that things will be, coming in, maybe a retraction, but the actual numbers keep advancing. This number wasn't quite out of the range. The unadjusted number was unadjusted year over year. Home prices are up 11%, very strong. Consumer confidence. This is a number that, if you look at this, the prior number was in the low 90s, and they thought it would come up, but it jumped almost 20 points, and came in about 9% above the top of the range. Now, the State Street Investor Confidence Index, this isn't like the previous confidence that we saw here, which is consumer confidence. This is a survey that people answer how they feel. So what State Street does, and that's what all of this verbiage down below says, is that they actually look at how institutional portfolios are positioned, how much equities they have, how much hedging and defensive positions they have. And looking at that, they get an idea of how confident investors are in the economy. So this was up strong, up at 2 points, and this is a generally high number. ISM manufacturing, this goes back to what I was saying about the strength in home building that's pulling forward a lot of demand for appliances and things like that. The prior number was a very high number. This was one of those numbers where 50 is baseline. So 60 is already very strong. Here, the consensus range was, 60 to low 60s, and it came in again fairly above. And this was all just this week. This was yesterday, and then today we had the employment report. This didn't quite, the non-farm payrolls didn't quite blow out the consensus range, but one of the reasons why I included it, they revised the prior month up by about 100,000. So if you look at that prior revision and you add that prior revision onto this month's number, because the consensus of 658 was thinking of 379 here. So to my way of thinking, this was a very strong number, and it helped push interest rates higher today. The bond market was open, stock markets were closed today. Two things I would point out in addition to the big non-farm payrolls number was private payrolls were huge, 780,000 of that, and they had a prior revision of about 100,000. But I'm looking at the average hourly earnings and average work week. Now, average hourly earnings dropped about a full percentage point. So what that tells me is a lot of these new jobs were maybe people going back to work in maybe things like the hospitality industry, restaurants and what have you, as states are opening up. And we saw some, people that have been furloughed from those jobs are going in and they're not getting, as much pay as some of the people that were working throughout the lockdowns. And the last thing I'd say about this, the average hourly work week of almost 35 hours was up 0.3 of an hour. That's a number, anytime I see 35 hours or so, that is a zooming economy for the United States. This is all the positives. We did have one negative, and it's a big one. And we got one more positive. Sorry, motor vehicle sales came out this morning. Prior month was annual sales figure of 15.7 million. They revised it higher. The consensus was for about 16. Actually came in at almost 18 million annualized vehicle number. Very strong. And this is in a market where we've been hearing anecdotally about companies having problems with chips and that they can't deliver sales. So, they're having trouble making them, but in this case, they still were able to supply quite a number. The only negative on the week was the pending home sales index was down. The prior month in February was down, and at the time, people thought that was because of the weather. So we had a solid down month here, and it brought the year-over-year index down quite a bit. So to the extent that I would say that since home real estate and home sales have been a driver of a lot of the economic strength that we've been seeing, we got to keep an eye on this, because this has been really carrying the ball. And a couple missed months in the middle of winter, okay, we'll see. But that's been what's been pulling the train, and we'll see how that goes. But if it continues to pull back, that would be a red flag.
Yeah, well, a lot of good data there, and obviously more positive than not. And perhaps on future broadcasts we can kind of like add some discussion at the end of each data point. But there's a couple things I want to go
Sure.
talk about. Obviously, on pending home sales, and I do a lot of work in another life with interact a lot with developers, especially residential developers, and as people have been monitoring, and obviously this is a very important input into the inflation equation. But not only are we seeing like really strong price response out of the industrial metals, but lumber is basically more than doubled to over $1,000 a board foot. And availability too, right? We're in an underserved housing stock environment. We've talked a lot, I'm sure, in your broadcasts and in my charts of the week and prior conversations here at Market Minutes about the choke points. You mentioned the Case-Shiller, excuse me, and that's really important because prices are continuing to move higher, right? And but we're also seeing a choke point in materials too, and in some cases, I mean, builders are not able to source, and I've been waiting to see builders try to hoard product so they can get homes built. But so far, the feedback I get is just in some cases, they have enough of four things, but not enough of the fifth thing, and that's basically kind of slowing home construction to a degree at a time where we really need it. And so I think that whole price basket that's tied to owner equivalence rent, that's tied to housing, as a component of the CPI, will probably continue to move higher. And then you mentioned the Purchasing Managers Index and the Institute for Supply Managers data. The manufacturing data continues to be really strong.
Oh yeah, absolutely.
And even though services account for a much more important percentage of the overall economy, manufacturing is still a really good. So you're going to go back to that. Okay.
Yeah,
cool.
yeah, I thought.
Yeah. And but to see this kind of response out of ISM, and I would absolutely agree with you that something maybe below 55 to 56 would be totally acceptable. Being a diffusion index, and everything above 50 represents expansion. But something on the order of what we saw in this data, despite the fact that we have a lot of clog in our system, and it's not just the whole Suez Canal choke point with shipping and trade. The ports of LA. You've been reading a lot of the same things I have. I mean, there's a lot of clog in the production channel, and to see manufacturing index as strong as it is, even with those choke points, I think is rather remarkable.
Yeah, it is. And on my other show, I've been highlighting the clogging at the ports really started last summer.
Absolutely.
But I did one other thing I just wanted to mention, aside from materials, when it comes to construction. And in the past several months, I've done a number of evaluations of construction companies and people that are in the construction related trades. Done several of them. In virtually every case, they're all constrained on labor too. They would have so much more ability to generate revenue if they just had the people. Wow. And that has been a major choke point in construction.
Well, and actually to that point, the lunch that I had today was discussing, about discussing that very point. And so the problem is you'd have materials that would not come at the appropriate time. And of course, you think about a home construction, it's very, very regimented. You've got, these steps that you have to do and you can't overlap in some cases, and then you'd have the crew sitting there and they get frustrated because they don't have either enough lumber or enough copper or something like that because of these sourcing choke points. And so they'd wind up walking off the job. And that was a frustration, but labor definitely noted as a choke point. And then your consumer confidence number, obviously it's, we both learned over the years, it's what the consumers actually do, not necessarily what they think, but obviously with the strong equity market, to the extent that we now have more individual investors that are investing in the equity market and they like what they see. And the fact that we've got a large amount of savings, especially amongst the higher income cohorts, I think that bodes really, really well, as we head towards the second half of the year. Wouldn't you think, Tom?
Oh, absolutely. And I think part of this reflects, I'm not sure exactly when what day of the month they do the survey or what part of the month, but it also reflects stimulus money. That definitely we've noticed. I think we've had 3 rounds of checks in the past year. There was a 2,000 last year, and then there was a 600, and then this latest one was a 1,400 per person for most people. Anyway, I've tended to notice when they do make those payments that it does help consumer confidence.
Yeah. Well, and the last one was a bit more targeted to the income levels that have been spending it. The higher income folks have been saving it. So the idea, the hope is that money gets into the economy, but not so much that it overheats. And now we're talking about the potential for a $2 trillion infrastructure bill that has it's kind of a multi-headed hydra awaiting to emerge from the ocean here. But we'll see what kind of horse trading goes on in Washington and what the eventual legislation winds up being. But that's more money that hits the economy. And I think, as we look at all of these different things, we've talked about lumber and copper, some of the soft commodities like cotton and corn. Some of those are either holding steady or they're actually falling off a little bit. But overall, we see a lot of inflation in the pipeline, and inflation expectations are building, and obviously that's manifesting in interest rates. But the real risk is that we have all of this money moving through the pipeline with a very accommodative Fed, and then we get to a point where we have all this sudden unexpected inflation impetus, right? That I think could put our equity rally into a pickle. I think we're all in agreement here based on the data that you just went through that the economy is clearly in expansion mode. And I think once we get to a vaccine level that's at least on par with where we are now in the States abroad, that this will be more of a synchronized recovery. But I think the real risk to those that watch this program is what happens with inflation and how do we see that. And I think that's probably worth spending a few minutes on.
That's been a theme of mine for months. Definitely. Just from a big picture, the idea of modern monetary theory, I think I only heard that like within the last couple of years. And, from our experience and training and what have you in finance, I just was like, is that really a theory? I mean, that's kind of a comic book thing, but what we essentially have now is that the federal government of the United States is practicing modern monetary theory. We are spending money like we don't have to pay it back, and
like drunken sailors. I mean,
it's unbelievable. Whether it's in relative terms or absolute terms are enormous. But even in relative terms, I heard we've spent we've had about $5 trillion of targeted stimulus since March of last year due to COVID. And inflation adjusted, the United States spent $4 trillion on all of World War II. I mean, think about that. 4 years building ships, planes, tanks, all the bombs, training all the guys.
Yeah.
4 trillion. And we've spent 5 in the last year.
That's a startling figure. It really
It's
is.
amazing. And we're talking about knocking off, you know, and I think the horse trading that you mentioned in Washington these days, it trades upward. There's no back and forth that arrives, you know, we'll start out at 3 and you're at 1.5 and we'll meet in the middle. No, it's like, how can we get to the highest number? And so I would expect that the number will come in well above 2.
Well, yeah, and we'll see. It could very well be. You know, I think, you know, having a split Senate, and obviously the Democrats have the tie-breaking vote, but there's some moderate Democrats that in high tax states that are definitely going to want relief on state income tax, or basically the restoration of that credit that their citizens could get for state income taxes paid. But we'll have to see. But I mean, already, if you look at the 10-year break-even inflation rate is 2.34%. The 5-year break-even inflation rate is 2.57, and this is essentially the 5 and the 10-year Treasury less the TIPS yield, which is a Treasury inflation-protected security equivalent. So the difference between those two yields is kind of this break-even inflation rate. So clearly, you know, we're below 2% now, but it's channeling a higher level of that looking forward. And I've just got a couple other data points. You know, we talked about output, which is really fantastic, and the numbers were really strong too. But ironically, it's in some elements, the factory output is rising at the slowest pace that it has in 5 months, and then a lot of that has to do with lack of raw materials. And then new orders rose at the fastest pace in almost 7 years. And that U.S. executives, according to HIS Market, reported the most severe supply disruptions since their survey work started back in 2007. And to the inflation point, in the Eurozone at least, factory managers reported the fastest rise in input prices in roughly 10 years, and the longest waiting time for inputs. So obviously demand has kind of caught up much faster than the supply chain has. And I think that's probably something, you know, that it's going to take a considerable amount of time to work through. And you mentioned semiconductors before, and that's, I read something even this morning that, you know, this tends to, I guess, suggest that we may not be back at equilibrium until, you know, for at least another 12 to 18 months.
Yeah, that's been a kind of a multi-pronged story. We did a bit of a deep dive on that a month or two back on my other show. Part of the deal is some of the substrates that actually go into the chips, and not the chips necessarily themselves, but again, these are materials. They're materials that a lot of people have never heard of. They're kind of fiberglass related. There's only a few places in the world that make them. And interestingly enough, there's been several fires that have destroyed some of these plants. I think 2 of them in Taiwan and 1 in Japan. So that's been kind of a critical choke point for just allowing chips to get made. The rest of it's kind of like what you were saying, you know, you can have 4 out of 5 things, but if you don't have it all, then you don't have anything.
Right. Yeah. So it's your purest definition of being as strong as your weakest link.
Right.
Which is something we used to say all the time back in my banking days. You know, talk about the market, you know, a little bit. Just some kind of somewhat random but interesting data points that obviously we've talked about. I've talked about, and I know you have on your show, about the difference in, the kind of the rising of the cyclical stocks, and you kind of alluded to it earlier. But Russell 1000 growth ETF is up 6.6% as of the end of last week, and the Russell 1000 value is up almost 27 since September 1. So if you think about that time frame, that's maybe 7 months, if you
Right.
will, more or less. So it's a huge rotation in market leadership, which frankly we haven't seen in a long time. I mean, growth has been the horse driver for a long time, and then we've seen this cyclical push, and we've seen the leadership change from essentially the five FANG stocks from last summer into the environment that we've got now. And I think in many respects it's a lot healthier, but obviously it's a manifestation of this feeling of this global, or this synchronized expansion, given that 40% of the S&P 500 revenues come from overseas.
Yeah, absolutely. I just, my gut feeling is I feel like growth is dominated going all the way back to the great financial crisis.
Mm-hmm. Absolutely.
And when you kind of think about the era beginning in 2009 as we came out of it, we heard it in the political arena, but it was the slowest recovery ever, at least since they've been keeping detailed statistics on it. So you had a lot of people that it was a recovery that was easy to supply. And a lot of people didn't believe it because they felt like, it could be taken away at any moment. So I think that was one of the reasons that really restrained a lot of the psychology and that fed into, well, we're just not getting, fundamental growth. And, at the same time, if you looked at housing, which is the main driver of the economy pre-2008, we went from building, 2.2 million homes in this country per year down to about 400,000 in about an 18-month period. And then, we're back up now to about 1.5 million pace, which is getting us back into that range. But those are huge numbers, and it's getting back into that range of building about 1.5 million homes a year that is enough to kind of pull the ropes taut, so to speak, on some of these commodity prices and really underpin a lot of the value drivers.
Right. Yeah. Those are excellent points. If we look at earnings estimates, obviously we had a very good most recent quarter. We've had a lot of upward revisions, and we had a lot of very positive conference calls from company managements that are issuing their forward outlooks. And I think the tenor of those conversations and their comments have been really positive. But know that earnings estimates over the last 6 months for the average S&P 500 company have been revised higher by about 8%. And probably more upside from there. And if we have even a little bit more, we know that earnings and obviously revenue are the mother's milk for stock market expansion. But I think that we run perhaps a little bit of risk of maybe understating the potential for the economy if we don't have some negative surprises on insofar as inflation goes. But we're seeing a lot more operating leverage overall. I think, we certainly, despite the fact that we've got some valuation dislocations, and, that we're looking at cyclically adjusted price to earnings ratios that are high relative to history, that there could be more upside, primarily because if we get this stronger than expected earnings growth, then that could render the PE multiples a little conservative, perhaps. But year to date, tech has underperformed by about 4 or 5%. We've had cheap stocks outperforming expensive stocks. We've had unprofitable stocks, outperform profitable ones, which is, not a dynamic that you'd expect over the long haul, but certainly over the last 6 to 9 months, that's been the case. And we've got One thing I read in Barron's over last weekend was 38% of all tech companies were unprofitable today versus 36 at the tech bubble peak, about 21 years ago. And then I mentioned already that unprofitable stocks appreciated considerably last year, and they continue to outperform profitable ones. We're seeing kind of an interesting market. And then, we haven't even started talking about the SPACs and the amount of issuance. That's a whole other conversation, but, pretty interesting dynamic, wouldn't you say?
Yeah, I just to put a period on the unprofitable stocks, especially in the value parts, like the Russell 1000. They're a little bit different than, say, a tech company that has been chronically, has never made a profit, and yet the stock is performing. A lot of those cases, that it may be a cyclical company that hasn't been profitable, but you can see the sun coming up, as things are heating up. So they're going and saying, okay, it's time to wake these guys up. And then that's where you're seeing, that the sun is almost on, and that they're bidding the prices up as the stocks their businesses are waking up.
Yeah, well, and over the last several years too, I mean, we've seen a decreasing supply of stocks, and so, with a lot of liquidity chasing around, and we've had this, this liquidity conversation for many, many years now because of easy money. One, two, we've had this consistent, asset purchase and very aggressive and accommodative monetary policy. And then now we get the physical component on top of that. And so, we've got stocks that are 15 times earnings or higher. The number of stocks that are trading at that level is the highest than we've seen in 20 years. And again, there's an argument to be made, right, that if earnings are increasing, then that's okay. And we know that, with low interest rates, that would typically translate into higher multiples anyway. But interest rates are moving higher. And I think, we could very well be, even though we've said this before, when we felt like we were at the bottom of the interest rate cycle and we were moving back up higher, that, this could really be the deal, because you can't throw, as you said, $5 trillion of stimulus and then more infrastructure spending, and a Fed that really no longer seems afraid of inflation at all. Right.
No, everybody's one up and everybody else who can shovel more money into the equation.
Right. And I just think that's going to set the stage for a higher, I think, a true normalization of interest rates over time.
Absolutely. I made the call last August. I was only a month after the absolute bottom, but I made a call last August that the 40-year bull market in bonds was over. The secular bull market that began when Paul Volcker broke the economy and crushed everything and crushed inflation. It was bold effort back then, but it ran its course. It was a secular bull market that lasted, most of my life, and now I think we're in a different world. The first thing that's going to happen, and I would say this about rising rates, is yes, they're rising and we are seeing some inflation, but part of it, I think, I see rising rates at this point as being healthy, showing demand, that the economy is perking up. What we don't want to get is like a stagflation where we see, rates are rising because of these structural issues surrounding inflation, and yet not the growth. At least now, we've got both pulling in tandem, and if we can continue to do that, it looks like we could have a pretty good year.
Yeah. Well, and you bring up stagflation. I think that's a really good point that that I think that is worth watching. right? I mean, because we know that we've got rising prices, and that's going to continue to manifest. I think it clearly is. But then, the ability for the economy to keep up with that and rise, and I mean, that's I would argue that interest rates are moving higher for all the right reasons right now.
Exactly.
And having inflation is not bad. Just the fact that we haven't had any, and that's been a real strong input into why we've had the continuation of that secular bull market in fixed income, is because inflation has gone down. It's helped, and it's helped long and short-term interest rates to kind of move down in tandem. But now that regime is changing, I mean, I think, we lived in a world when when I started in the business, and people were financial planning, and they were using 3.5% inflation in their forecasts. And now people have gotten a lot comfortable using like 2%, which is the Fed's target rate. But, even just having looked at the break evens now, I mean, those break evens are migrating back up to 2.5. So, I think, stagflation is one thing, and then the sudden burst of negative inflation, which gives people a reason to sell. But there's still a lot of money chasing assets right now.
Oh yeah, yeah. It's the money hasn't, it's been it hasn't found its way into useful useful parts of the economy. It goes into the financial part first, and so we have seen some some goosing. You were mentioning SPACs earlier. That the SPAC thing has been kind of interesting to me, because on the one hand, I always wondered why there was this kind of it was really a convention where they would price IPOs at below where the market would have them, because they wanted that first day goose.
I want that pop. Yeah.
But the company, if you're owning a company, why would you want to have your stock pop 50% on the first day when you can capture that money and sell at the right price, have your IPO come in flat, but then you've got more money in your treasury? Well, it's like, well, you want to set a good tone and have everybody, feel good about you. I never bought that, because they they won't feel good about you the first quarter you disappoint. But leaving that aside, what I'm seeing with the SPACs is the SPACs have stepped in and said, okay, if you're a unicorn and you want to go public, we'll do it, and we'll pay you the premium that you were foregoing when you didn't collect everything you could by doing an IPO. And so, somebody's getting the money, but now it's not individual shareholders. It's, the unicorn holders.
Yeah. And I think, it's worth mentioning that, back in the tech bubble, I mean, not that SPACs weren't around back then, but they just weren't utilized to the degree that they are now. I mean, we've already in just one quarter of 2021 have more issuance of more SPAC IPOs, I should say, than we had all of last year. And last year was an increase of at least 3x over the last 5-year average. And what it's doing, like back in 1998, 99, you had IPOs of pets.com, and we remember all those the ones that spent way too much money advertising in Super Bowls, but they didn't have a business plan, and they were nowhere near earnings, or let alone revenue positive. And we have the case now where we've got a lot of these SPACs that are it's almost a celebrity thing. You've got Shaquille O'Neal and all these celebrities that have formed their SPACs to go acquire these companies that really are not ready to be publicly traded companies yet. And in many cases, I've seen a couple very prominent examples, here, in our region, that are great companies, but they're pre-revenue. They're still in development mode. I mean, but it's turned into a fairly decent vehicle to raise money. I'll be very interested to see what happens to SPACs going forward, in an environment where we are getting together, and you can do road shows, but the cost of doing an IPO versus having essentially a reverse merger into one of these SPACs is considerable. But it used to be when a SPAC came public, and this is the shell, right? This isn't the acquisition. This is the shell, that you'd have like this huge, to your example earlier, to get this pop over that $10 net asset value. Well, now they're underpricing those things because there's so many of them out there, and they're all rushing out to find the next company. And the thing is, we're going to see a lot of companies that are just going to go belly up.
Oh yeah, everything goes too far. That's one of the rules. And usually I think, whenever I start get into a conversation like this, is like, just the fact that we're having this conversation, is that maybe the kind of the, like, has it already gone too far? Because the first few, I think they always soak up, make some pretty good deals, get somebody who really, drove some returns, but then you get, the Wall Street factory then just jumps on it and starts riding it, and it starts to get pretty crazy. I just don't see, in most of the cases, I don't see the compelling reason for wealth creation in the equation. But that's a sign of excess. Kind of like we had a little bit of a sign of excess this week with the Archegos situation.
Yeah, you want to talk about that a little bit?
Yeah, I was going to talk about Archegos a bit because it's maybe one of the most blatant examples of over-levered situation that we've seen. For those who hadn't followed, Archegos was the name of a family office that was run by a guy named Bill Huang, who had once upon a time been a protege of Julian Robertson at Tiger Asset Management. And then when Julian closed his fund in 2000 or 2001, he had a lot of top drawer talent that went out and started their own hedge funds. And Bill Huang was one of them. But he started one that was focused on Asia. It was called Tiger Asia Management. And Tiger Asia ran into some serious trouble in 2012 and had to close down. He pleaded guilty to insider trading on Chinese banks, had to pay fines in the US and in Hong Kong. And he was barred from the hedge fund industry. So what did he do? He goes and he forms this family office and starts buying stocks. Not sure, whether exactly what his funding was, whether it was truly just his own money, but he started being able to leverage positions. And in just this year, he became the largest economic owner in Viacom. By my estimate, he owned about 15-16% of Viacom on an economic basis, but he had cut these deals with these prime brokerages, which are all Wall Street banks, that basically said, we'll keep the stock, but you have all the risk of it. So these were called total return swaps. So he didn't have the asset on his books. It was Goldman Sachs and Credit Suisse that would have the assets on their books, but then everything that stock did from the second they bought it was on his books. And so he was taking all the risk. And my understanding is that he built it up to about $100 billion. his equity was only about 10. And then last week, it was Friday morning a week ago. I saw the news first thing in the morning. It said that Goldman Sachs and Credit Suisse or Goldman Sachs and Morgan Stanley were each dumping about $17 billion worth of stocks. I thought, wait, that's weird. I said that they're, because of the Volcker rule and Dodd-Frank that were enacted after the great financial crisis, banks aren't allowed to maintain what they call proprietary trading or prop trading books. And yet I'm hearing about these huge blocks of stock that are being dumped. And I'm like, that is not inventory. They are doing something here. And then it came out over last weekend that, because of these total return swaps, that they had them on their books. There will be investigations. But the bottom line is that Bill Huang had built up $100 billion worth of notional assets with only about $10 billion worth of equity, and it was wiped out in about 3 days. And part of it was, and this gets back a little bit to some of the dynamics that you have if you're, say, in the executive suite. Let's look at Viacom, which was really the boulder that caused the avalanche, was that because of Huang's buying and everything else, that Viacom, which had been about $35 a share last fall, had tripled by the weekend before last to where it was $100 a share. And so if you're buying, of course, then there's rumors everywhere. Is this a GameStop situation? Is somebody pushing it? Is this are they in secret talks to be acquired? Are they going to go out? And the weekend before last, they executive management basically decided, with our stock having tripled in just a few months, let's sell some. So they announced a big offering to sell $3 billion worth of stock. Like, they can do that. If management in their executive capacity decides, hey, this is a great time to raise some money, which they did. Well, guess what? As soon as they made that decision, it did a number of things. First, it took a takeover off the table. It told all the analysts that this wasn't a run-up based on them talking to anybody. They're selling. Number two is that by diluting all of the current shareholders, it's going to reduce earnings per share because there's more shares. So between just the dilution of more shares coming on to the market, the fact that there'd been a huge run up, yet a bunch of analysts come out and downgraded the stock went down 20% in one day. And it was that 20% that caused Bill Huang's fund to then get a margin call to where they had to start selling to meet the calls for margin. And those were driving down the prices of his stocks. And the process really wound up by last Friday and then carried over into this week, into Monday. So you had Viacom, old school company, that went from $100 to $45 in about a week.
Yeah. Well,
kind of went back to where it was.
Yeah. Well, I mean, this is, you mentioned GameStop, which is another discussion entirely. And I think a very interesting dynamic of, David versus Goliath in some respects. But this, I think they both represent, this manifestation of this large move that we've had from the trough. And, this, you build up a lot of froth now, regardless of what the fundamentals are, right? And earnings and things like that. But you have this price reaction that has essentially enabled Huang, right? Because of this continued growth, and he built up leverage along the way because of all this notional price appreciation in those swaps, right? And so it just takes a little bit, just as you're gaining, you gain a lot of leverage on the way up, it reverses it on the way down. So you introduce just a small modicum of volatility, those things can unwind pretty quickly, but you typically don't see those types of vehicles You certainly don't hear about them in the news when the market's, trending at a, 5 to 7 to 10%, average level. We've just had such a strong move that it's really almost provided this, this enabling aspect to these things. And this just happens to be the one in the paper that's, I think, what I don't hope is that we get a lot of backlash regulation, but it will be interesting to see what happens. I know Elizabeth Warren has, taken the opportunity to talk about it, and we'll have to see. I don't know if you've read anything on that.
Yeah, I have. Oh, and we're certain to get hearings where you're going to have a number of congressional legislators that all they really want to do is have themselves tape themselves speaking, not really listening. It'll be pure theater. The structural thing here, though, is interesting because I'm just going to go back to the fact that Huang had been barred from the hedge fund industry from just a few years ago, and the main thing is that first of all, it provides a contrast to solid guys like ourselves. We'll plug ourselves here that you want to deal with somebody reputable. My feeling from 35 years in the financial securities industry has been that when I see guys that stray like Huang did in 2012, they don't change their stripes. No. And to the extent if anybody's ever telling you, oh well, that was a long time ago, or different circumstances, don't believe it. I mean, just run away. Don't walk.
Yeah, I totally agree. It really that sums it up right there. And it shows you that with all the legislation that we've had to try to curb untoward behavior in our industry, that there's still those loopholes. And this may very well put like family offices in the crosshairs of regulators now.
Yeah, and it will. Yeah.
It seems like the pendulum hardly ever rests in the middle. It's always to one side or the other, and then now you get this overreaction of, but again, yeah, clearly, it's somebody who's been barred, being allowed or being permitted by almost omission, right? In a way, but being able to back in through this family office loophole and do what he did,
And the other thing that I thought was fascinating was Goldman Sachs, once he formed his family office in 2014 or 2013, Goldman Sachs refused to deal with him until 2017 because of what had happened. And they were like, this is a reputational problem. But what did they do? They fell into the FOMO, fear of missing out.
That's right.
He had all these other banks. He was dealing with Morgan Stanley, Credit Suisse, Nomura, Deutsche Bank, UBS, and they're all making bank on him. So after a while, they're like, yeah, we got to get in the game. And that's a structural weakness where I don't know what the incentives always are, but it seems like the guys that have their hands on the steering wheel aren't necessarily incentivized the same way as maybe they should be if they knew there was going to be a clawback or something. Because I would have loved to have been. I'm sure, and for our viewers out there, there's plenty of articles you can dig into, Financial Times, Wall Street Journal, Barron's, that have done deep dives on this. But everybody talks about, there was a conference call last Thursday night between his 8 prime brokerage banks. And, they're all kind of, I guess, learning exactly how bare the cupboard is. Yeah. It's like, how are we going to deal with this? I would have loved to have been on that call. And it shows you how, from my notes here, that Credit Suisse and Nomura Securities were the two that were most leveraged to him. And so they were urging this kind of teamwork thing, like not everybody, don't panic. Let's take about a month and simmer this down and slowly spread it out. And Goldman Sachs and Morgan Stanley said, nah, we're not going to be able to do that. One, everybody's going to find out. And two, it may not even be legal for us to all get together and do this in conjunction with each other. It could be considered price fixing or some sort of collusion. So they were Goldman and Morgan Stanley and Deutsche Bank. Those three banks were the ones that were out first. And by selling first, they didn't really lose any money, but they kicked off, and so the losers
they were the catalyst to the price movement.
They were, but they were incentivized to, hey, let's flatten our book as soon as we can, and they did, and they didn't lose anything or minimal, whereas Credit Suisse and Nomura lost billions, and they are.
That's the case of music. The music stopped, and they were still left holding the bag.
Yeah, musical chairs. They didn't get to sit down, and I would bet, and this is just kind of I especially with what else has gone on at Credit Suisse, which is beyond the scope of this discussion, but I don't know how the CEO of Credit Suisse is going to last more than a couple of weeks. I think they're going to have a complete changeover there, and they probably need to, but maybe even this weekend.
An interesting topic. So appreciate your insight on that. It's something that I obviously we've both read about, but to synthesize that for our viewers, and that was probably a really deep dive for most people. But again, I think it's an interesting development. It probably won't be the last time that we see an attempt to try to game the system like that. So, but we just continue doing good fundamental analysis and try to forge ahead and have a long-term view. And I guess to close today, really, there's a couple of things, and Tom, I'd offer some quick bullet points to you, and maybe you're looking at some of the same things, but as we look at, things that we need to pay attention to, we've talked about inflation kind of ad nauseum. I mean, watching the data points that we're getting incrementally, and watching the recovery in employment. So we'll get another data point next month, and we'll see the progress that we continue to make. And we had a lot of hiring in a lot of areas. I mean, construction was a fantastic read for the payroll report this morning. So we have that. We've got, we haven't talked about coronavirus, but I mean, that is part of the charts of the week pack. You can look at that, but we've seen maybe a little bit of an uptick. You got a shot. I got a shot.
I got my first one yesterday.
Well, I got my first one on Monday. I need to get my second one here before too long, but maybe a slight rise in cases. And then, we've got some reopenings and, things that we can talk about, like the Ranger Ballpark being the only major league ballpark in Major League Baseball that's opening to full capacity. So if that is a fantastic laboratory to see if this whole notion of if we're getting anywhere close to herd immunity. But and then obviously the Biden proposal, the infrastructure proposal, and what the taxes are going to look like and how those discussions are going to transpire. But clearly, I mean, we do have the end of the pandemic, in our rangefinder, and we know that corporate earnings are really going to have a record year this year. We're already seeing that, and we talked about that a little bit. And then the economy is going to have a fantastic. We know that we're going to have fantastic economic data. So, kind of those are some of the things that I'm watching. And if you have any others, real quick to pipe in before we close today, and no,
I think those are all valid. The one thing I would say, just to go back to the Archegos a bit, that is not a sign of an impending financial apocalypse. Just to put some folks at ease, these things happen, and they don't necessarily always happen at the top. They do always happen because of leverage, but a lot of people were pointing out that this was the biggest thing since long-term capital. Long-term capital happened in 1998, and the bull market of the 90s didn't end until 2 years later. So, you know, it was a blip along the way. But I think what made it hard was the fact that with a generally good market that you could have a blow up like this.
And that's an excellent point. So, so obviously the takeaway today is that we are optimistic. There are things that we're watching. Appreciate everyone staying with us and spending your time to watch Tom and I go back and forth. And I think I speak for Tom in saying that I had a good time. I had fun doing this, and I think you know, we want to try to maybe continue this a little bit. So if you have thoughts or suggestions or even cares or comments, you know, please feel free to share them with us. And I hope you have a safe week. Hope you have a wonderful Easter weekend, and look forward to chatting with you again next week.
Same here. Take care.